Under the leadership of the Honorable Maxine Waters, it is my singular honor to convene this historic hearing to examine the role of financial institutions in the horrors of slavery. The enslavement of Africans was an epitome of evil, and its stain on human history cannot be sanitized with the passage of time. It was a horrific crime against humanity that demands redress, a crime which cannot be whitewashed with a solution of ignoble ignorance. This is in part why, large part I might add, I introduced H.J. Res. 64, calling for an annual day of slavery remembrance to prevent the sanitization and whitewashing of our seminal sin, slavery. We have a day, friends, to remember 9/11 and commemorate the thousands of lives lost to terrorism. We have a Pearl Harbor Remembrance Day to ensure that December 7, 1941 will forever be a day that lives in infamy. We have a Holocaust Remembrance Day to prevent the horrors of the Holocaust from ever being repeated. Dear friends, we need a Slavery Remembrance Day, not only to remind us of the horrors of slavery, but also the need for atonement. And although the practice of slavery may have been legal at one time, it was without question a profoundly immoral practice necessitating atonement. Consequently, it becomes important for banks, insurance companies, and other financial institutions with historic ties to slavery to atone. Recognizing that atonement is part and parcel to our need for reconciliation, and we have not reconciled in our country, I have introduced H.Res. 919, calling for a cabinet-level Department of Reconciliation with a budget indexed to the Department of Defense and a Secretary of Reconciliation who reports directly to the President, very similar to having the Department of Labor with a Labor Secretary and undersecretaries, I might add, the Department of Commerce, all of the various departments. We need a Department of Reconciliation such that we can reconcile. Reconciliation won't take place over a short period of time. This department would be as enduring as the Department of Labor is. And friends, although atonement for our seminal sin, the dehumanization and enslavement of human beings has been too long delayed, I do not believe that the zeitgeist of our time will allow the suffering of atonement to be denied forever. I look forward to hearing from our witnesses on how contemporary financial institutions could address their history with slavery and provide measures of atonement in the present day. Thank you, and with this, I conclude my remarks, and I now recognize the acting ranking member, Mr. Timmons, for 5 minutes for an opening statement.
Mr. Chairman, I want to thank you for holding this hearing today, and to our witnesses, thank you all for taking the time to appear before the committee and share your research and experience. This afternoon, we are prepared to listen and learn, and I look forward to hearing everyone's perspective. Being from South Carolina, I'm keenly aware of my state's and our country's as a whole history with race. While slavery ended with the Civil War, there are still visual reminders in my state of this dark past. You can still see the scars on our state house from General Sherman's March to the Sea, in our capital city of Columbia. In Charleston, the marketplace where human beings were bought and sold still stands as a stark reminder of our country's original sin. But I've also seen the new South that we've built together in the years since these tragedies occur, and it is a much different place. Does work still remain to right wrongs? Absolutely. But there is no denying the monumental progress we have made The legacy of slavery and the persistent racial economic disparities in the United States are linked, and we will discuss that history today. A number of the banks and insurance companies that we are going to discuss today have acknowledged their history and their connections to the practice of slavery. This is an important step, and I look forward to hearing from our witnesses about where those companies should go next. But we also need to be mindful of the fact that rising prices are making matters worse for households of color. The current inflation rate is 7.9%, the highest in my lifetime, which means that for working class families as well as seniors on fixed incomes in my district and across the country, it is getting harder and harder to make ends meet. This plainly shows that inflation is exacerbating racial disparities. Data from the Federal Reserve and the Bureau of Labor Statistics show that Black, Hispanic, and Latino households own their homes at a lower rate than white households. In an inflationary environment, rents tend to rise. Meanwhile, paying the mortgage becomes relatively cheaper, relatively easier. The net effect is an expansion of racial disparities. The same factors are at play when it comes to buying groceries and paying for gas in the last year or so. An analysis of CPI data by economists at Penn Wharton found higher income households had smaller percentage increases in their total expenditures because they spend more on services, which experienced the smallest price increases in 2021. On the other hand, lower income households spend relatively more on energy and groceries, whose prices had large increases. So again, inflation is causing racial economic disparities to expand. As we listen to the history of banks and insurance companies who financed slavery in the United States, I hope our witnesses will provide some important context and help us connect that history to contemporary disparities in home ownership and wealth. The data related to racial disparities make clear that households of color are at a huge disadvantage when it comes to navigating inflation. I think we have a responsibility to legislate with that in mind when we consider bills that may further affect the rate of inflation one way or the other. Again, Mr. Chair, I want to thank you for holding this hearing today, and I look forward to the testimony from our witnesses. I yield back.
The gentleman yields back. The chair now recognizes the chairwoman of the full committee, the gentlewoman from California, Ms. Waters, for 1 minute.
Thank you very much, Chair Green. Financial services institutions played a powerful role in financing chattel slavery. Insurance companies provided the financial protection necessary to transport stolen people from Africa to the United States and to protect slave owners from loss when a slave died. Banks provided loans to finance the purchase of slaves and accepted human beings as collateral. And some of these institutions are still in operation today, including J.P. Morgan Chase. Today, this committee continues its work to address systemic racism. So I do look forward to discussing the actions of our financial industry, what they can do to take remedy and deal with the lasting effects of their having profited from the enslavement of human beings. I yield back the balance of my time.
Thank you, Madam Chair. Friends, at this time, we'd like to welcome the witnesses. It's my preeminent privilege to welcome our witnesses and to indicate that we are looking forward to your testimony and greatly appreciate those of you who are here for traversing some distance to be here, and those of you who could not make it in, we look forward to hearing from you by way of technology, and we're grateful that you're there as well. Our witnesses are Dr. Dinah Ramey Berry, and she is the Oliver H. Radke Regents Professor and Chair of the Department of History at the University of Texas at Austin. We have Dr. William A. Darity, Jr., and he is the Samuel DeBoer Cook Professor of Public Policy, African American Studies, Economics, and Business at Duke University. We have Professor Stephen Beckert, and he is the Laird Bell Professor of History at Harvard University. We have Ms. Nikitra Bailey, She is the Senior Vice President of Public Policy at the National Fair Housing Alliance. And we also have Dr. Sarah Fetterman. She is an assistant professor at the School of Public and International Affairs of the University of Baltimore. Witnesses are reminded that their oral testimony will be limited to 5 minutes. You should be able to see a timer that will indicate how much time you have left. Without objection, your written statements will be made part of the record. Dr. Berry, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Good afternoon, Chairman Green, Chairwoman Waters, and members of the committee. It is an honor to come before this body and share my testimony on the legacies of slavery and connections to financial institutions. I have been studying this history for 30 years, and I appreciate the invitation. Enslaved people were valuable financial investments, so valuable that financial institutions, municipalities, universities, private citizens, and medical schools bought, sold, gifted, deeded, traded, mortgaged, leased, and transferred enslaved people as a form of legal tender. Human chattel were foundational to the Western economies from the 15th through the 19th centuries. They were one of the most unique forms of commodity and assets because they were human beings. Defined as chattel, a movable form of property, we have records confirming their value at every stage of their lives, from preconception to postmortem. We also have documents that clearly outline the connections between enslaved people and specific financial institutions, such as insurance companies and banks. Those records can be traced from slavery to the present. Such legacies reverberate throughout our society today and are reflected in all kinds of disparities. The wealth gap is so wide that most of us will not see it narrow in any appreciable way in our lifetimes. Turning to insurance companies, the Southern Mutual Life Insurance Company, founded in 1848 under the name of Georgia/Southern Mutual, shows evidence of profits generated from insuring the bodies and lives of the enslaved. During the second year of offering policies to enslavers, the company saw growth from 28 to 239 policies. It reported that most of those who purchased policies were modest enslavers who had, quote, a small number of slaves who they were dependent upon, unquote. Thus, they secured their income by taking policies on the lives of human property. Looking at policies from 1856 to 1863, we learn that the company insured enslaved people from age 1 to age 60. Some policies were for 1 month or 2, other policies were for as long as 5 years. Regardless of the length, each enslaved person underwent a medical examination to determine their value, and the company set premiums and rates based on their value. Although this company originated in Georgia, Southern Mutual Life Insurance Company had agents throughout the South and is still present today. In addition to individual policies, some states, including Maryland, passed legislation that encouraged people to purchase policies on the enslaved. Here, the state supported policies that helped enslavers search for self-liberated or runaway enslaved people in order to recover the cost of those who absconded and had been away for, quote, a reasonable period of time, unquote. The enslavers could make money off of those who escaped. The fact that enslavers could make money off of those who escaped is remarkable. They also made money off of what we call elderly at that time. 40-year-old Ehrlich was valued at $2,000 for 1 year with a premium of $80 and a percentage rate of 4% on his policy. What do these numbers reflect in terms of contemporary times? 51-year-old Charlotte was valued at $800 in 1860, which was equivalent to nearly $23,500 in 2014, and I would argue much higher today. Insurance policies alone help explain why some enslavers kept elderly enslaved people. Many would not command the insured value in the market. However, they could be replaced with someone younger at death. The banking industry literally facilitated transactions related to enslaved people by extending loans, securing debts, gifts, and deeds of trust, and banks including Citizens Bank and Union Bank kept track of collateral payments, issued notes, that involve the enslaved whose names can be found throughout the records. I would like to close my remarks with the voices of the enslaved. After freedom, Henry Banner shared, quote, "I was sold for $2,300, more than I am worth now," unquote. Tempe Herndon and other enslaved women understood that their monetary value was linked to their fertility. "I was worth a heap because I had so many children," she explained. "The more children a slave had, the more they was worth." Hardy Miller remembered that enslavers paid $100 for every year you was old, claiming, "I was 10 years old, so they sold me for $1,000. While Martha King remembered her sale at 5 years old. She went on the auction block with her grandmother, mother, aunts, and uncles. "I can remember it well," she said. She told interviewers in the 1930s. "A white man cried me off just like I was an animal or a varmint or something." She also remembered her monetary value. "Old man Davis, give him $300 for me." Today I share these testimonies as part of mine so that the enslaved voice is heard in the halls of Congress 150 years after the 13th Amendment, because the wealth generated from their labor still serves as the foundation of the American economy. Thank you very much.
The gentlelady's time has expired. Thank you very much, Dr. Berry. Dr. Darity, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Thank you, Mr. Chair. In our book, From Here to Equality, Reparations for Black Americans in the 21st Century, Kirsten Mullen and I argue that the fundamental attribute of a reparations plan for Black American descendants of U.S. slavery must be elimination of the racial wealth gap. The Black-white wealth gap serves as the premier economic indicator of the cumulative intergenerational effects of American racism on the conditions confronting living Black Americans whose ancestors were enslaved in the United States. As economist William Spriggs puts it, the racial wealth gap is the central measure of opportunity stolen from Black Americans. The minimum sum needed to close the Black-white chasm in wealth is $14 trillion. Only the federal government has the capacity to fund such an amount. If private individuals and institutions paid $1 billion a month into a reparations fund, it would take a millennium for the fund to reach $14 trillion. The combined budgets of all state and local governments in the United States are less than $3.5 trillion. It would take 4 consecutive years of devoting all of their spending to a reparations fund, thereby foregoing all of their usual obligations to their constituents to approach $14 trillion. The true reparations plan must necessarily be a federal project aimed at making direct payments to eligible recipients in an amount sufficient to build average Black assets to a level comparable with average white assets. However, this conclusion is not a recipe for paralysis on the part of private individuals and institutions, nor other levels of government for that matter. There are steps that can be taken to enhance racial equity by these institutions, even if they cannot execute a project for true reparations. For example, a central financial weakness of historically Black colleges and universities, HBCUs, is the underfunding of their endowments relative to predominantly white institutions, PWIs. Private institutions do have the resources to facilitate elimination of the HBCU endowment gap. I turn to Louisiana to illustrate the possibilities, a state where its 4 historically Black colleges and universities have significantly lower endowments per student than peer predominantly white institutions. I match comparable institutions. So the gap per student between the state's 2 Catholic institutions, Xavier and Loyola University, is $7,650 per student. The gap between Tulane University and Dillard University, 2 non-denominational schools, is $13,000 per student. The gap between 2 of the public universities in the state, Grambling State and University of Louisiana, is $12,230. And the gap between the 2 land-grant institutions, Southern University and Louisiana State University, is $14,575 per student. To close the endowment gap would require, at minimum, an additional contribution of $26 million to the endowment for Xavier University, an additional $28.75 million to Dillard University, $61.4 million to Grambling State, and $102 million to Southern University. The total would amount to approximately $218 million. There is compelling evidence that larger endowments per student are associated with higher graduation rates, but increased endowments are unlikely to be sufficient to bring about full improvement in graduation rates. The target for all the institutions should be at least to match Tulane's graduation rate of 85%. But closing the endowment gap holds tremendous promise for improving the quality and performance of the HBCUs. It will give them an opportunity to fully excel and to go beyond the accomplishments that they've achieved on the basis of meager resources. Who among potential private contributors could take on this task effectively? Certainly the banking sector has the wherewithal, since the top 10 banks in the United States have combined assets of approximately $13 trillion, albeit assets that are held with varying degrees of risk. The total needed in Louisiana amounts to a blip on the financial horizon. They could take these beneficial steps towards greater racial equity without doing major harm to their balance sheets. Thank you.
Thank you, Dr. Darity. Dr. Beckert, you are now recognized for 5 minutes to give an oral presentation of your testimony.
At Harvard University. I'm honored to have the opportunity to meet with this committee, and I have submitted written testimony summarizing my views. As a scholar of the 19th century United States who has worked extensively on the question of the role of slavery in U.S. economic development, I want to give you some background on the issues in front of this committee, and I would be delighted to answer any questions that you might have. First and foremost, I want to emphasize that slavery was exceedingly important to U.S. economic development. Initial findings of an ongoing research project have shown that during the 1840s and 1850s, between 10 and 14% of the US GNP derived directly from the labor of enslaved people. In large parts of the South, almost half of the regional GNP was produced by enslaved people. We also know that the capital stored in these enslaved people exceeded the combined value of all of the nation's railroads and factories at the time. The most important industry using enslaved workers in the 19th century, cotton production, produced about 5% of the nation's GNP in 1850. And cotton constituted more than half of the United States exports in most years from the 1820s to the 1850s. These numbers are significant. Even if we take the lowest estimate and assume that just 10% of the nation's GNP derived from the labor of enslaved people, that unpaid labor mattered greatly to the American economy. We can see this clearly if we compare it with contemporary industries. In 2021, all manufacturing activities in the United States combined contributed 11% to the nation's economic output, which is roughly the same share the labor of enslaved people contributed during the antebellum years. These numbers are also still incomplete. The economic impact of slavery went beyond the actual production in agriculture and industry. Many other industries directly served or benefited from slavery as well. They included northern manufacturers supplying the southern plantation economy, the slave trade itself, mercantile houses, industries dependent on slavery-produced inputs, as well as banks and insurance companies. Therefore, if we do not yet know the exact figures, we do know that the total importance of slavery and slavery-related industries in the United States in the 19th century was definitely greater than just the value produced by the labor of enslaved people alone. It is mistaken to think only about the southern states when thinking about slavery. Slavery's economic impact was national in scope. Also, northern states began abolishing slavery in the wake of the American Revolution. Northerners were deeply implicated in enslavement. Northerners shipped, insured, and financed plantation crops. They provided plantations with manufactured wares, and they used plantation crops in industrial production. To comment on the subject at the core of your deliberations, financial institutions played a crucial role in enabling enslavement, making slave labor profitable, and facilitating slavery's territorial expansion. The United States was the world's most important supplier of the industrial world's most important commodity, cotton. As cotton fueled an industrial revolution, European and US financial institutions rushed into the cotton business. Slavery rested on the capital, institutional know-how, and varied services of the finance sector, and it was the finance sector that connected plantations to factories and London money markets to New Orleans credit markets. Advances on crops enabled planters to acquire land and enslaved workers. Planters offered the enslaved workers as collateral to access capital markets. While most credit relationships in the antebellum South were mediated by so-called factors, these factors in turn drew on banks and merchant bankers to finance the growing of the crop and the extension of agriculture into new areas. And this applies both to private banks as well as to public institutions such as the first and second banks of the United States. Insurance companies, as we have heard, were also involved in slavery. Since much of Atlantic trade consisted of the products of enslaved labor, marine insurance received a boost from an expanding slave economy. Life insurance also expanded under slavery, and scholars have estimated that beginning in the 1830s, several thousand life insurance policies were written on the lives of enslaved people. The historical evidence is therefore clear. Slavery was an exceedingly important part of the US economy before the American Civil War. It also had devastating effects on millions of enslaved women, men, and children, and it left a deep legacy of patterns of inequality in the United States. While millions of African Americans labored for generations without pay and under inhumane conditions, the wealth they produced accumulated elsewhere. In 1860, for example, white Southern men made up 59% of the wealthiest 1% of adult males in the United States. Many Northern merchants, manufacturers, banks, and nonprofit institutions gained from the uncompensated labor of African Americans. Meanwhile, African Americans received no compensation for their labor and could not secure family networks or accumulate property. They could not access educational resources and suffered from extreme forms of exploitation and maltreatment. After slavery, African Americans continued to suffer more than a century of further economic, social, political, and educational discriminations. The legacy of patterns of inequality and opportunity, or the lack thereof, that came from slavery is with us in the United States to this very day. Thank you.
Thank you, Dr. Beckert. Ms. Bailey, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Member Emmers and other members of the committee. Thank you for the opportunity to testify at today's hearing. I am Nikitra Bailey, Senior Vice President of Public Policy at the National Fair Housing Alliance, the country's only national nonprofit civil rights organization dedicated to eliminating housing discrimination and creating equitable opportunities. As I represent and office more than 170 local fair housing enforcement agencies today, my testimony honors the sacrifices of my ancestors. Despite founding principles of justice and liberty for all, the atrocious institution of slavery helped to establish the United States as one of the world's largest and most competitive economies. The free labor of enslaved Blacks undergirded the financial health of America and its institutions. Every American institution stands on this foundation, including banks, where the institution of slavery revolutionized credit markets, creating complex new forms of financial instruments and trade networks through which slaves could be mortgaged, exchanged, and used as leverage to purchase more slaves, according to Professor Baradon. The legacy of slavery endures. It is woven into every aspect of our economy and continues to manifest. Let me name a few. The Freedmen's Bank, created to provide Black soldiers and their newly freed citizens a secure place for their savings, ended up being looted by its white trustees. Despite its promise of economic freedom and self-determination, in the end, more than 60,000 of its depositors lost $3 million, which was nearly half the wealth of Black citizens. I ask you to imagine for a moment the toil it took these Black Americans to amass $3 million, as most worked on the very same plantations where they were enslaved as sharecroppers in a system that locked them into perpetual debt. The unfounded association between race and risk and financial institutions established by New Deal housing policies. The Federal Housing Administration systematized lending discrimination as its policies both reflected and reinforced the practices of banks and insurance companies. FHA provided affordable housing for whites, leaving communities of color relegated to riskier, costlier, wealth-stripping financial services. Other examples, the $1 trillion for Black and Latinos lost during the subprime mortgage boom after being steered into risky products that led to foreclosure despite many qualifying for loans on safer and more affordable terms. The failure of lenders to maintain homes in communities of color that they took back through foreclosure or to market those homes in a manner that would maintain neighborhood stability. And during this current crisis, failing to provide lower interest rates and the cost savings to consumers of color, placing them at greater risk of foreclosure during this COVID-infused housing boom. White homeowners have been able to save $3.8 billion through refinancing annually in comparison to $198 million for Black homeowners. The Federal Reserve's ongoing monthly support of mortgage-backed securities is fueling these disparities while simultaneously allowing investors to buy up all of the affordable housing stock. The stain of slavery spreads well beyond our banking system, but it is appropriate for this committee to focus on the role of banks because they are different from other kinds of businesses and they have a special relationship to the federal government. As the United States Supreme Court stated, national banks are instrumentalities of the federal government created for a public purpose. They are critical to the effective functioning of our economy, facilitating financial transactions, providing liquidity, and serving as a vehicle for monetary policy. Because of the public interest in these functions, the government gives banks special treatment that no other businesses get, such as deposit insurance, access to the Federal Reserve's lender of last resort, and a system of regulation that curbs risk and boosts public confidence. Now is the time to redress the legacy of their involvement in slavery and ongoing discrimination, not only to stop discriminating, but to take affirmative steps to heal the harms done over centuries. Following the people-led protests in the wake of the murders of Mr. George Floyd and Ms. Breonna Taylor, financial institutions made bold pledges to extend billions of dollars in the pursuit of racial equity. Fulfilling those pledges will not cure the stain of slavery from their foundations, but it will go a long way in advancing opportunity for the descendants of the enslaved. This committee has also taken action to address these issues, particularly the housing provisions in the Build Back Better Act, especially the first-generation down payment assistance from Chairwoman Waters' bill that ended up in the bill for $10 billion. We need the Senate to act without delay to pass this legislation so that all of us as a nation can start to take actions for atonement. I look forward to discussing my other recommendations with the committee. Thank you again for the opportunity.
Thank you, Ms. Bailey. Dr. Fetterman, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Thank you for inviting me today. My research considers how corporations can atone for participation in mass atrocity, such as genocide and slavery. My comments are based on 2 projects, one involving the French National Railways, known as the SNCF, for its efforts to atone for participation in the Holocaust. My second project came at the urging of my Baltimore students, who rightly encouraged me to study corporate atonement for slavery. Through this, I discovered Alexander Brown and Sons, founded in Baltimore, first in cotton, then shipping, and then fundamentally developing investment banking to fund plantation agriculture. Legacy companies exist today, as do those of Barings Bank. It's easy to look at a city like Baltimore and think that its golden days have passed. Those who followed the wealthy bankers and industrialists just didn't care for the city the way they did, one might think. But a deeper look suggests that the poverty, addiction, and violent crime we see today is not unrelated to how those industrialists acquired their wealth. Where to start? Well, for those seeking atonement, it is tempting to treat today's executives as the slaveholders themselves. Though their institutions benefited from slavery, today's individuals inherited these histories, they did not write them. So we want to separate the people from the problem. And there is a problem. That institutional wealth has compounded for over 200 years without addressing the souls that suffered for it or harm the inflicted upon descendants. I offer a corporate historical integrity model in my recent Harvard Business Review piece. In it, I advise corporations to commission an independent study of their history, to update their company's origin story based on these findings, make a public statement about the history, often an apology, and especially engage with affected communities to develop a meaningful response, commemoration, compensation, and other programs. Some examples of companies doing this work. JAG Holdings commissioned an independent study of its Holocaust connections and will make that public. They've also donated to Holocaust education. Georgetown University now works with the descendants of the slaves it sold back in the 1800s to determine the best use of the funds it will raise. The SNCF, the French National Railways, opened its archives, put up plaques, funds Holocaust commemorative activities, and engages its survivor communities. But perhaps most relevant today is Lloyd's of London, an insurance company. They've researched their historical ties to slavery. They've made those findings available. They've opened their archives. They've offered an unequivocal apology on the website. They also outlined their commitment to develop Black and minority talent, increase Black and minority hires, and prevent participation in slavery in their supply chain. Their statement on the website reflects the correct spirit, I believe. Quote, "We approach this work with profound humility, a spirit of openness, and real enthusiasm for change. We will continue to listen to and be guided by our Black and minority ethnic colleagues." But what about U.S. financial institutions? America's 50 biggest public companies and their foundations collectively committed roughly $50 billion since George Floyd's murder to address the issue of racial equity. That sounds great. However, the Washington Post found that more than 90% of that amount is allocated as loans or investments they could stand to profit from. Many people don't need more loans, they need help paying them. Brookings Institute studies show the Black-white disparity in student loan debt after graduation. Therefore, if we engage with communities, we'll see the need for student loan forgiveness, the need to offer free higher education to 3 generations of descendants. We'll also see the need for housing assistance grants, as we've heard, better public transit, grocery stores, healthcare access, childcare, elder care, after-school programs, and music and sport. Engaging with the communities also addresses the enormous dignity violation of slavery and segregation inflicted. To make any of these programs without people's input reinforces a paternalistic approach to their participation in society. Furthermore, corporate efforts towards racial equity will fall flat unless the companies take seriously their own institutional histories. I'm grateful for this collective opportunity to respond to a too long unatoned for aspect of our history. In addressing it together, we can help heal our country and be who we say we are. Thank you.
Thank you, Dr. Fetterman. Friends, votes are being called shortly, and we will have to move to the floor to cast our votes. The committee will stand in recess and reconvene immediately following the conclusion of this series of votes. I do want you to know that you have my apologies. I would not have this happen to you if I had my way, and I rarely get my way, but if I had, I assure you, you would not have to wait while we cast these votes. But do know that we will be back immediately after votes have been cast. And the committee will stand in recess. And witnesses, if you would, I'd just like to come down and thank each of you individually, if I may. The committee stands in recess.